Today topic is Safe Investment Playbook, M2W. This session is about understanding risk, how to build a balance, and how to create a structure that help us stay invested comfortably over long term. So now we can go to our first. Now before we go further, I want to clarify something very important. What we really mean when we say safe investing, because many of us understand this term. Some investors think safe investing means zero risk, but in reality, zero risk and long-term growth usually don't go together. If we avoid all risk, we may also miss opportunities to grow wealth over time. So similarly, safe investing doesn't mean guaranteed returns. Market don't work that way. There will always be movement and some uncertainty is natural. So what safe investing actually means is a controlled risk. It means understanding how much volatility we can handle and structuring our portfolio in the way that doesn't force us into any kind of emotional decision. Let's say if your portfolio falls a little and you started to feel very discomfort or stress, that usually tells the risk level is not aligned with your comfort level. That doesn't mean the investment itself is wrong. So even risk level will be differ. So safe investing tries to reduce that mismatch. It focuses on protecting capital first, not by avoiding growth, but by avoiding the unnecessary risk. And over time, the goal is to steady growth, not sudden jumps are followed by the sudden falls. So next we can talk about something very practical, common mistakes that many of us make. So they actually happen because market create a emotion, the excitement when things goes up and fear when things go down. So first common mistake, the concentration risk. When we see one asset class performing well, it feels natural to put more money there. For example, if equity markets are doing well, some investors gradually move most of their savings into equity without realizing how concentrated their portfolio has become. The problem is not equity itself. The problem is the lack of balance. So the second point is the chasing trends. Another common behavior is chasing what is trending in the market. We are something at somewhere, some asset class performing well, maybe a sector, maybe a theme, and we feel we should not miss out. But trends often look strongest near the peak and not at the beginning. So decisions made purely on the recent performance can increase risk without us realizing it. So next, third common mistake is the no time clarity. One thing we see very often is investing without the clear timeless. If we don't know when we might need the money, even normal market ups and downs can feel uncomfortable. So time horizon is like a cushion. Without it, small volatility also may feel big. So fourth and the common mistake is the emotional decision. So making the decision out of fear or excitement. Uh, Market move, that's normal, but when decisions are driven only by emotions, investors often buy when confidence is high and they sell when confidence is low. So the goal is to not avoid investing, it's to avoid reacting too quickly to what the market is doing. So why too much risk cuts long-term wealth? This simple cycle explains why taking too much risk can slow down long-term wealth creation. Even the intention is to grow faster. Uh, because many investors believe higher risk automatically means faster wealth growth, but in reality, the journey is not always a straight line. So first step, you can see the big when big losses occur. So everything usually starts when portfolio takes it a large fall. Markets move or corrections happen, that's normal. But when portfolios are heavily concentrated or overly aggressive, the impact of correction becomes much larger, and this is where the cycle begins. Uh, and also, if you see the losses happen, don't just reduce money; they also change how the investors feels. So next is recovery takes time. So after a large fall, the recovery takes a lot of time, and this is something many people underestimate. Even strong markets don't recover instantly; they move gradually. During that recovery phase, patience becomes very important. A portfolio may need months or even years to fully recover, depends on how deep the fall was. So next is time gets wasted to getting back to the zero. So one hidden cost of high risk is time. When portfolio falls deeply, a significant part of the journey is spent just getting back to where we started. So that means wealth is not actually growing during that period, it's simply recovering. So time is the most valuable source in investing, and the deep drawdowns consume the time. So if all this happens, so investors start to lose the confidence. Now it's the emotional side part. When recovery feels slow, or then when the confidence starts to drop down. This is where many investors make decisions that interrupt long-term compounding. They started to reduce the exposure. They will stop the existing investments or SIPs, or some of them are fully exited from the market itself. So and finally, your wealth growth gets delayed. So instead of growing steadily, the portfolio keeps moving through the cycle, loss, recovery. Sometimes you hesitate, and sometimes you delay your investment. Over time, your wealth growth journey also slowed up, not just because of market fail, but because of the risk we fail to not to the balance. So moving into the next slide. So we have three simple buckets. You can see the growth, stability, and liquidity. This is one of the easiest way to understand how we a stable investment approach. It's first we can see when many people start investing, they usually focus only on growth. They want their money to increase faster, which is completely common. But over time, we realize that growth alone cannot carry the entire journey. Just like in real life, we need balance. Some part of the portfolio should aim to grow. Some part should help produce ups and downs. And some part should remain accessible when life throws surprises. So first, we can see we're in growth bucket. So this is where a long-term wealth creation usually comes from. Growth assets move faster, sometimes strongly upward, sometimes it may start downward also. But that's okay because the growth is meant for long-term. But the mistakes many investors make is trying to keep everything in this growth asset itself. When markets are rising, it feels comfortable, but when markets corrected, the same thing will creating the emotional pressure. So growth is important, but growth alone cannot create the stability. So if you see in the middle, it's a stability. Think of this is the part of the portfolio that helps to smooth your journey. It may not always deliver the highest returns, but it reduces the intensity of markets. That's very important because when the entire portfolio moves too sharply, investors tend to react emotionally. The stability component act like a buffer. It gives the portfolio structure, allowing the growth investments to do the job, but without constant stress. Many of us underestimate because it feels less exciting, but in reality, this is often the reason investors stay invested during the difficult market pieces also. And finally, we can see the liquidity here. This is the most practical part of safe investing because liquidity simply means having access to funds when needed without disturbing your long-term goals. This is where an emergency fund also plays a role. Unexpected expenses may happen, your medicals, or any job transition, any family situation. If there is no liquidity buffer, investors may be forced to sell the long-term investments at the wrong time. But when liquidity is planned properly, it removes the pressure of you. So if so now we bring it together, something interesting happen. The portfolio start feeling more balanced. Growth continues to build with stability, reduces the sharp movement, and liquidity handles the short-term needs. So instead of reacting to every move, the investors feels in more in control. That's the real purpose of balance, not to eliminate growth, but to make growth sustainable. So here we can see how a different asset class behave differently. If on the previous slide, we spoke about three buckets: growth, stability, and liquidity. Now let's go one level deeper and understand what actually sit inside those buckets, because different asset classes behave differently, and understanding that behavior help us build balance more intelligently. So Let's focus on the deal. Start with the equity, which we discuss as part of the growth. Equity is usually the main driver of your long-term wealth creation. Over long periods, equities have the potential to generate much higher returns, but that higher returns comes with higher volatility, and volatility simply means that prices can move sharply in the short term. For example, equity may rise 1 year very strongly, and it correct next year. Sometimes started to consolidate for a few years. That doesn't mean equity is bad. It just means equity needs more time. So equity fits naturally in the growth part, not because it is always stable, but because it has the potential to create a long-term wealth. So equity generally rewards the patient. It's not the short-term expectations. So now move to the debt. Debt which we earlier linked into the stability, because debt investment generally aim to provide more moderate and stable returns compared to the equity. They usually experience lower volatility, which helps smooth the overall portfolio journey. Now that doesn't mean debt never moves. It also have that interest rates and economic condition, inflation. This also can influence your debt returns. But compared to equity, debt often behaves more steadily. This is why stability is not about removing growth. It's about combining growth with something that balances the movement. So in simple terms, debt helps reduce the emotional ups and downs that pure equity portfolios doesn't sometimes create. So next, we can see precious metals like gold and silver. These often play a different role. They may not always lead in the strong bull markets, but during the period of uncertainty, like inflation concerns or economic stress or any uncertain global events, they sometimes act as a, think of them as a diversify rather than a primary growth engine. Their role is not to outperform everything all the time, but to behave differently when other asset classes struggle. So this is where the idea of balance becomes clear. Equity drives long-term potential. Debt helps to smooth the journey, and the diversify our production layer like metals behave differently during uncertainty. When these all elements work together, the portfolio stops depending on a single outcome, and that reduces pressure on us. So instead of asking which asset class is best, and the more useful question becomes, how do these asset classes work together? So we just see the fixed income in a more detailed way. So because it tends to behave more steadily compared to growth-oriented instrument. That doesn't mean it never moves. As I said, the interest rates or market conditions still affect the performance, but the movement is often less sharp compared to the equity-heavy exposure. And that difference in behavior helps balance the overall portfolio exposure. It's not fixed return; it's a stabilizing growth. During the stock market corrections, if you see portfolio that depends on entirely on growth asset can feel uncomfortable. When stability-oriented components are present, they may reduce the intensity of overall swings. This gives investors the breathing space, allowing the long-term strategies to continue without constant reaction. This is also why some of the investors look at debt-oriented or conservative hybrid structures where stability form the large part of the foundation. So third point is emotional comfort during volatility. Investing is not only about numbers; it's all about the behavior. When portfolio moves too sharply, emotions often take over. So when a when a portion of the portfolio behaves more steadily, investors feels confident and they stay invested in the long term. So that emotional comfort is often it plays a big role in the long term consistency. So the fourth point is balance when risky assets start to struggle. So no single asset class lead all the time. There are cases where growth assets slow down or move sideways. During such periods, stability-oriented components may help balance the journey, not by outperforming everything, but by behaving differently. Uh, See, the next is and also you can see many people naturally compare fixed income with the traditional options like fixed deposit. So because FD offers clarity and fixed predictable returns which serve a specific purpose. So fixed income strategies within portfolio often serve a different role, helping the structure the journey alongside growth assets rather than replacing completely. So the focus is on portfolio balance, not a different comparison, not direct comparison. So until now, we have spoken about safe investing from a structured point of view. Now understanding risk balance and how different asset class behave. But investing is not just about markets; it's also about where we are in life. So because the same investment approach doesn't work equally well for everyone. A person just starting their career thinks differently from someone managing family responsibilities, and very differently someone from approaching the retirement. So rather than asking which investment is universally safe, a more useful question becomes, what does safe investing look like at different stages of life? Let's look at how priorities shift and how stability plays a role as these priorities change. Now we can think about the early career stages. One big advantage here is time. So at this stage, income is still growing. Irresponsible maybe fewer, and there is more room to learn from market ups and downs. So investing here is less about the perfection and more about building the right habits. So so yearly investing is often about a consistency rather than size. So even small investments made regularly help build discipline, understanding how market moves, how portfolio behave, and how emotion changes during ups and downs. These habits become extremely valuable later part of our life because investing confidence doesn't come from theory; it comes from experience. So and next is handling the market's ups and downs. One of the most important learning in early career is seeing how markets behave over time. There will be phases where returns look strong and phases where markets are slows down. So experiencing both helps investors develops patience instead of reacting to every movement. They begin to understand the volatility is a part of the journey. So learning to stay invested during uncertainty is one of the strongest skill of an investors that can build early part of the life. And also it's at this stage, a growth-oriented approach is often accepted because time allows a recovery from short-term fluctuation, but growth doesn't mean taking risk without structure. Even early career balance matters. The goal is not maximum risk; it's meaningful growth aligned with long-term goals. And fourth one is avoiding risk without purpose. So, and finally, one idea that applies at every single stage is risk should always have a solid reason. Taking risking simply means something is trending or performing well can create unnecessary pressure later. So, when risk is aligned with goals, it feels manageable. So, when risk has no clear purpose, it start to become stressful. So yearly career investing is less about getting everything right and more about building habits that support stability over the long term. So as we move into the mid-career, priorities often begin to change. Your responsibility may increase. You have to have a more need to be a more family planning. You may have home loans, and also you have the same long-term financial goals. At this stage, investing decisions are no longer just about growth. They are also about protecting the progress which you already started early phase of your career. So first point is there were responsibility increases in mid-career. Financial commitment usually become more structured. EMIs, children's education, future planning. These bring a different perspective to the investor. So yearly volatility might have felt manageable, but now sudden market swings can feel more personal because investments are connected to the real life, your goals and milestone. So next thing is stability becomes more important. This is where stability starts playing a larger role, not because growth is no longer important, but because balance becomes necessary. So investors often begin shifting from purely growth focused thinking toward a more structured approach that combines growth with protection. So stability here is not about reducing your goals, it's about protecting the downfall. So that points the big losses. So one challenge during this phase is the large portfolio declines can interrupt your long-term plans. Recovery is still possible, but time feels more limited in this space compared to the early stages. That's why managing downside becomes just as important as aiming for higher returns. So, and the final part is balancing growth with production. At this stage, investors often focus on building a portfolio that grows steadily while reducing unnecessary shocks. This would mean introducing more stability-oriented products alongside growth exposure. Uh, the, go- the point is to not avoid markets, but to make the journey smoother and more predictable and safer. So as we move closer to the retirement phase, investing priorities naturally begin to change again. So early stages focused on building wealth and managing growth is important, but during the pre-retirement phase, the focus gradually shift towards preserving what has already built. So first thing is volatility ratings is closer to retirement. At this stage, market volatility often feels very different compared to early years. When retirement is approaching, large portfolio swings can create emotional pressure, not because markets are unusual, but because timelines are shorter. The same market movement that once felt manageable may start to feel uncomfortable now. This is very natural because it's not about fear; it's about the change in your priorities. So next thing is predictability matters more than the growth in this space, because as retirement get closer, predictability becomes more valuable than the aggressive growth. So we often start looking for investments then that begin in a more structured and stable way, allowing us to plan cash flows and our future expenses and lifestyle needs with the better clarity. So predictability here doesn't mean avoiding growth entirely. It means choosing stability where it actually matters the most. And the final part is the capital protection becomes a topmost priority here. So because at this stage, protecting the accumulated wealth becomes a core part. So the goal shift from maximizing the returns to reducing the risk of the major setbacks. Even small adjustments towards stability-oriented strategies can make the investment journey more smoother and more comfortable. So capital protection is not about stopping the growth; it's about safeguarding the progress which we have made in our early phase of the career. So pre-retirement investing is less about seizing the next opportunity and more about creating the confidence for the next phase of life. So now we can see one of the practical. See, we can see the do's and don'ts here. So first, we can see have a clear goal and the time horizon. One of the strongest way to reduce stress is investing is having clarity about why you are investing and how long you can stay invested. When goals are clear, shorter market movements feel less distracting. And next, more important is keep investment balance. We spoke earlier about growth, stability, and liquidity. Balance doesn't mean reducing your ambition. It means creating a structure where different parts of the portfolio supports each other. And most important thing is review portfolio periodically. So regular review is not about reacting to every market's noise or ups and downs. It's about making small adjustment over time. So the portfolio continues to make change, continues to match the changing priorities of you. And final thing is stay disciplined even during the market swing. So market will always move. That's a part of investing. So discipline doesn't mean ignoring market. It means avoiding sudden decision based purely on emotion. So consistency often matters more than timing here. So on the don't part, you can see that as we discussed earlier, don't maybe when something outperforms strongly, it's natural to feel curious, but decision based only on recent performance can increase risk without improving the long-term outcomes. And the second most important thing is putting all money in the one places. So it can feel rewarding during the stock markets, but balance becomes important when market conditions start to change. And also we can see acting on the fear or some emotion driven decisions are one of the biggest reason portfolios lose momentum. That's why structure and planning matter. They help reduce impulsive reactions. So, safer investing is not about completely avoiding the market. It's about building a structure that allows you to stay invested comfortably across different stages of life and different market conditions. So now I want to briefly share how we think about investing at M2W. That is a milestone to wealth. Everything we discussed today, stability, life stages, risk managements, come together into a simple philosophy. The idea is to not chase market, but to build progress step by step. First thing you can see is the milestone based planning. At M2W, we often look at investing as a journey of milestones rather than one big destination. Instead of thinking only about reaching one goal directly, we break the journey into achievable steps, maybe 2 lakhs, 5 lakhs, 10 lakhs, and 25 lakhs, and gradually moving towards a larger milestones. Why we are doing this? Because reaching smaller milestones smoothly builds the confidence, and also it reduces the pressure of trying to achieve everything at once, and psychologically it makes the journey feels more structured rather than uncertain way. So progress becomes visible, and that visibility helps investors stay consistent. The second thing is safety and discipline over chasing returns. So one thing we strongly believe in is that long-term wealth is built through discipline, not sudden decision. Because market will always present opportunities that look exciting, but focus only on trending pot can sometimes increase the risk unnecessarily. So the philosophy lean towards building stability first and allowing growth to happen gradually. And the third point is behavioral coaching and conviction building. Another important part of investing is the behavior. Even well-structured portfolios can feel uncomfortable during volatile periods. So a large part of the approach involves helping investors stay aligned with their long-term goals, building the conviction during both stock markets and the challenging pace of the market. So this includes developing the patience to look at fair value or some undervalued opportunities rather than following what actually is already giving you returns or already in the trending pace. So, and another thing is review and adjust through milestones. So as milestone, each and every milestones are reached, portfolios are reviewed and adjusted periodically. So not because markets change overnight, so but because so your investing priority also evolve. For example, the approach taken at 5 lakh may not be identical to the approach at 50 lakh or beyond. So milestones are structured evolution rather than sudden shift. So the final thing is multi-asset. Customized portfolios using a multi-asset base. So and finally, risk management sits at the most important thing. So rather than depending on a single asset class or theme, portfolios are often built using a multi-asset perspective in combining the growth, stability, and diversification. So it is important to participate with awareness of valuation and the long-term sustainability. Sometimes it means looking beyond what is currently trending and focusing on opportunity that is undervalued or temporarily overlooked. So that approach requires a patience, but it aligns with the idea of steady milestone-based progress. So the M2W way is not about predicting markets; it's about guiding investors through milestones, managing risk carefully, and helping them stay invested with clarity and conviction. So finally, the kind of final part of our webinar is our more of the key takeaways we can see. Uh, it's milestone to wealth M2Ws. It's a branding and right. So finally, we can see is the don't aim to be right every year. So in market, there is always a pressure to feel right, to pick the best performing idea or to avoid every downturn. But investing is an exam where every year needs a perfect growth. Sometimes portfolio may look quite slow compared to trending opportunities, and that's okay. Consistency over long periods often matters more than being right in short periods. So and the most important thing is avoiding big losses. One thing many experienced investors realize is that growth doesn't come from chasing the biggest win. It comes from avoiding the setbacks that slow down the progress. If your portfolio fall heavily, a lot of more time goes into simply in the recovering phase. So safe investing is less about finding the fastest path and more about choosing a path that keeps moving you forward to the goal. So steady progress often beats the dramatic swings in the market. So, and most important thing is let time to the heavy lifting. We often understand how powerful time can be when the structure is correct. So instead of constantly adjusting direction, sometimes the strongest strategy is allowing investments the space to grow naturally. Uh, Time works best when portfolios are built with balance. Sometimes we discuss throughout today's sessions also. So stay invested and be patient. So I think patience is one of the most underrated skills in investing. Markets will test confidence sometimes through noise, sometimes through uncertainty. But when the structure is aligned with goals, staying invested becomes a lot more easier. And over time, that patience becomes a quite advantage. So if there is a one idea to can take away from today is safe investing is not about avoiding markets or predicting every move. It's about building a journey that feels sustainable across different life stages, different market cycles, and different milestones. So thank you for spending your time today. I hope this session give you a clearer and easier way to think about investing.